Investors are increasingly positioning portfolios around a singular expectation that the U.S. economy will run hot as we approach the 2026 midterm elections. This consensus, reflected in equities, credit spreads, and inflation expectations, is not just a reflection of economic data. It is a structural bet on how policy incentives, fiscal frameworks, and institutional constraints will interact over the next year. At the core of this narrative is official data showing robust output growth well above long-term trends. Measured GDP growth has exceeded market expectations, and forecasts suggest further acceleration. Against this backdrop, major stock indices are at record levels, and risk assets have remained buoyant. But what markets are pricing is not simply stronger numbers. They are interpreting the institutional incentives embedded in the U.S. political and policy cycle. In an election year, fiscal authorities face pronounced incentives to engineer conditions that look economically strong in the short run. Tax cuts, deregulatory measures, and increased public spending are all levers that can temporarily lift headline growth and support asset prices. These are not neutral policy tools. They alter the expected path of aggregate demand, interest rates, and risk premia. Investors are betting on fiscal expansion, in part because it has historically been used to bolster cyclical performance ahead of elections. The expectation of further tax reductions and deregulation increases projected corporate cash flows and compresses equity risk premia. At the same time, there is speculation that monetary policy will become more accommodative later in the cycle, even as the Federal Reserve maintains current interest rates. The Federal Reserve's recent decision to hold rates steady despite above-target inflation illustrates the institutional tension between central bank independence and political pressure. Fed policymakers cited robust economic activity and a stabilizing labor market as justification for maintaining current rates, signaling that there is no urgency to ease monetary conditions. This stance preserves the Fed's operational autonomy, but markets are simultaneously pricing in rate cuts further out. That divergence suggests a bet that monetary and fiscal incentives will ultimately converge to support continued growth. Market-based measures of inflation expectations have also moved higher. This reflects not only underlying economic conditions, but also the terms of the bet investors are making about future policy. Higher inflation expectations reduce the real burden of fixed liabilities and increase nominal earnings projections, which in turn affects valuations across asset classes. The willingness of investors to accept higher inflation risk indicates confidence in sustained growth or in continued policy support to sustain it. Yet the institutional picture is more nuanced than a simple optimism narrative. Structural fragilities persist. Consumer confidence metrics have lagged, even as headline GDP measures remain elevated. Segments of the economy, particularly lower-income households, are experiencing stagnation or contraction in real purchasing power. This bifurcation highlights that strong aggregate statistics can mask distributional imbalances and sectoral weaknesses. Furthermore, key risk assets have decoupled from traditional economic indicators in ways that reflect capital market reweighting around policy expectations rather than fundamentals alone. Major technology stocks have driven equity indices higher, while broader measures of economic participation like employment growth and wage dynamics present a more mixed picture. The capital market's collective position on the U.S. economy ultimately embodies a hedged judgment about political economy mechanics. Investors are not merely forecasting macroeconomic aggregates. They are embedding assumptions about how political incentives will shape fiscal and regulatory frameworks, how monetary authorities will respond, and how these forces will affect discount rates and future cash flows. This is precisely why seemingly contradictory signals, strong stock markets alongside weak consumer sentiment, can coexist within the same valuation regime. Markets are pricing policy trajectories as much as they are pricing economic performance. Anticipated tax changes, regulatory adjustments, and government spending initiatives are transformed into valuation inputs, altering expected returns across asset classes. There is an inherent feedback loop embedded in this framework. If fiscal stimulus does effectively boost growth in the near term, it can reinforce positive valuation dynamics. But that same mechanism can also elevate inflation pressures, which, if unchecked, can force monetary tightening or signal future constraints on fiscal space. The juxtaposition of short-term political incentives and long-term institutional constraints creates a policy risk premium that markets must price. In practice, a market pricing a hot economy ahead of elections reflects a deeper calculus, a belief that political actors will prioritize immediate cyclical gains over structural balance, and that markets will benefit from this prioritization in the short run. This is not a technical forecast. It is a judgment about how institutions, electoral incentives, fiscal authorities, central banks interact within a system of governance to shape economic outcomes. For analysts and strategic actors, the implications are clear. To understand market dynamics today, one must move beyond surface economic indicators and dig into the institutional and incentive structures underpinning policy decisions. This means incorporating political economy into valuations and recognizing that economic expectations are as much about rules and incentives as they are about raw data. In this regime, market pricing becomes a reflection of a broader institutional equilibrium, shaped by anticipated fiscal actions, regulatory postures, and central bank behavior. The question isn't simply whether the economy will grow faster or slower. It is whether the underlying incentive structures that drive policy decisions will persist and how those incentives will continue to influence market expectations. That is the institutional analysis that informs not just where valuations may go, but why they have been drawn in the first place and what structural pressures could cause them to shift.